Thank you, everybody, for joining us on this Thursday for our Connected Capital Fund webinar. And we have three of our friends, fellow fund managers on this call. But let's start with Manish and Senate, and then Philippe, if you can maybe share a little bit about yourself, your background and your experiences in capital raising.
Yeah, sure. So I actually am a computer scientist. I did almost 20 years of tech startups in New York and Silicon Valley. I pride myself about the fact that I think I've been raising capital since 1994. So this is something that has been my primary job. And I've kind of raised capital in New York, in Silicon Valley, around the world, in Middle East, in China, in Europe, and I have faced all kinds of situations in all kinds of institutions. And that's how when I got into real estate, I found that depth of experience in convincing different motivations and different concerns that people have, and the kind of, you deal with rich people that don't look at any financials, and they just look at the trust factor. And then you deal with Wall Street types that are, they're paid to do an MRI on your business plan. So you learn to see the value in projecting trust, credibility, but also doing the hard work behind the scenes before you go out and start raising capital in terms of the arguments you're presenting to people about why they should invest in what you want them to invest in.
Excellent, excellent. All right, Senate, your experience in a little bit about yourself and how you got into fund management, and maybe a little bit about your capital raising.
Yeah, thanks so much for the opportunity to be here. I'm glad to be here. So I started in real estate in 2009 in the single family space, and I worked in that arena for almost 10 years, and I did over 100 transactions in the single family duplex, triplex era, and just kind of got burned out on the turn and burn methodology, and got into multifamily and commercial real estate in 2019, and started selling all my singles and moving them all into multis. And I quickly figured out that I'm going to run out of money. I'm not going to have enough money to do this on my own. So I've got to start learning how to raise capital and work with other people. And so in 2020, I started my journey of raising capital and deploying it into private equity. And since then, I have done 21 deals where I have raised money from other people, 16 multifamily, 1 build-to-rent development, and now 4 business opportunities. And I also do a lot of coaching and teaching beginners and helping people get started in multifamily.
Excellent, excellent. Thank you, Senate. And Philippe?
Yeah, glad to be here. So my name is Philippe Schollegen. My background is the aerospace industry, and until for a good 20 years, until I started to do some real estate investments back in 2017, and transitioned to full-time in the real estate in 2020. I'm now co-founder of Boost Capital Group and manager of the Boost Wealth Fund. So we help busy professionals who want to preserve and boost their capital through passive investments, mostly real estate. And we're going to explore other asset classes in the future as well. So until now, we have helped investors build a portfolio over 4,000 multifamily units, which is our core asset class for the time being.
Wow, excellent, excellent background, guys. I mean, these are the kind of expert members in the community that we are so proud of. And, we have 2 coaches level here, somebody, all 3 of you, such deep kind of expertise in the realm that you have been working in. And by the way, just want to, with a show of hands, how many of you have heard about Connected Capital and how many are new, right? So let's just say that, how many have you heard about Connected Capital, just with a show of hands? Um, just 3 out of the 51 attendees. 4. Okay, yes, perfect. Light that up. So about 10 people raising their hands out of 50 attendees. So let me actually, give you a little context to why, what are we even talking about and why we are here. First of all, we are very grateful this Thursday evening you are here. So Connected Capital is a community mainly for capital raise partners, also for high net worth individuals, family offices also. What we do is that we collectively, through our sphere of influence, source the deals, really high quality deals, do a collective due diligence. Due diligence is kind of the DNA in Connected Capital. That's the core of it. One person, it's very hard to do that due diligence, but we do it collectively. And that's what the topic, the core heart of the topic today is. And once we do the due diligence, if there's a green light for that deal, we negotiate good economics for all of us together. We go as a separate checks, but we raise capital on it together, right? So that's the kind of a core of the community. So we're just talking about, these 3 panelists today are integral member of Connected Capital, contribute so much, brings so much of expertise in that due diligence area, right? So just focusing on due diligence, right? So why due diligence is so important, right? So let's hear it from our panelists that, Sined, Manish, Philip, so grateful that you're here and you're sharing your perspective. But from your perspective, as a capital allocator, right, you chose your lane. You're not operator, you're capital allocator. Why is due diligence such a crucial when deciding whether you're bringing these investments to your investors? How and why is it crucial to you? How does it impact that trust, kind of a long-term success for you? So we'll start with probably Sanet here.
Yeah, thanks, Madhvi. So due diligence is important because your investors, the people that we're talking to, are trusting us to bring them deals that are really good. And what I say is to my investors is I would not bring a deal to you that I wouldn't put my mom in or my sisters in, people, my family, my own money and my family's money in. And the only way I can confidently say that I would do that is if I have done all the due diligence that I can potentially do to vet it, to make sure that all of the risks that are potentially there have been mitigated.
Love that, a deal that you can bring your mom in. I love that values, that, kind of a deep ethics that you have. Philip, what do you think about it? Why is it important to bring this really high quality deal and not just glance at, operators' history and something? Why is due diligence more important to you?
Well, I think it's a combination of factors, but I'd say what's really important, for crucial factor for success of a deal is to have a deal that is high quality, that is meeting certain threshold in, say, market selection, expertise of the team, how sound is the business plan. And, I think at the end of the day, in order to qualify these different areas, these different, really key indicators for us, that we're pursuing, there's only due diligence that allow you to do that, right? Because so you're going to check that the team has the experience that is required, they have the knowledge of the market, that for instance, the property that we're looking at has the characteristics that we're looking for, that the rent's at the right place, etc., etc. So really, build the confidence that we are meeting certain parameters that will improve the chances of success of the deal. That's what we're looking for, and that's what we want to extend to our investors.
Yeah, I love that. Not falling for the shiny numbers. If they have the numbers in there, is the probability of that's gonna work or not? Manish, give us your perspective, please.
You know, you got to have a vision, right? I mean, we know the current state of the real estate market. You can go out and really make a fool out of people. And I'm just a very sincere guy. I don't like to sugarcoat things. You go on social media, you got people on blast putting deals out there, and there's a significant amount of American population that really doesn't understand finance, especially in the medical community and a few other areas. And they literally invest based on what's being advertised. But if you go to the institutions, if you go to people who know what they're doing, they will go out there, they will visit properties, they will meet teams, they will kick around the tires, they will check the reasoning behind every number. I just did a small tiny deal in Tennessee, and my lender was Fannie Mae, and man, they ripped everything apart. And and the reason why Connected Capital exists is right now it is very hard to find a sincere people that you can bounce ideas off of. That it's not about simply due diligence. It's about talking to people who tell you the blunt truth. I gotta tell you, the bluntest guy in Connected Capital is right here, Senate. He will tell people to their faces that he doesn't believe in that deal. So you want to hear that kind of stuff. And I go around, I go to hundreds of, not hundreds, but quite a lot of events. Connected Capital is one of the few places I've found where people are blunt and sincere in their investigations about what makes a good investment. And I don't think you can ask for anything more than that in a due diligence.
I love that. I think we are known to ask difficult questions, and these difficult questions need to be asked in the beginning of the life cycle of these deals. Yeah, Bobby, you want to go ahead with the
Yeah,
next?
absolutely. If you can't make the sponsor uncomfortable, then you're too easy on them. So you got to ask those difficult, challenging, and probing questions. So anyway, very good, very good. Sometimes we want to be polite to everybody, but this is not about being polite. This is about doing business and asking the right questions. So anyway, so Philippe, what was it like before you joined Connected Capital? It's coming up on a year. How are you sourcing deals? And what was your approach to due diligence prior to Connected Capital?
Yeah, that's a good question, Bobby. So, deal sourcing was really through relationships, networking, being part of different communities, attending conferences, and so on. And I think one of the challenges is like all these relationships, they take a lot of time to build, right? Until the point you can trust people. So I think what was interesting is with Connected Capital, now is the size of the team. We're attracting good sponsors, and that's very important for us to work with very experienced, very successful sponsors. And so the second question was,
How did you do your due diligence prior to?
Yeah. So due diligence. Well, it's like we are doing everything, by ourselves. So, looking at the market analysis, deal review, the underwriting. So, it's a pretty long process, right? And I'm doing some mentoring on multifamily as well. So, I know very well, like teaching it day in, day out. I know what to look for deals that when they are good, when they are bad, from a number of analysis standpoints. And that's what we are doing ourselves, just re-underwriting the deal and making sure that all the numbers we're checking out. But also, like I mentioned earlier, part of that was building that relationship, that trust with the sponsor was very important. And I love what we do with Connected Capital, because we go beyond that. We go, we do background checks, for instance, so that brings an extra layer of certainty about the sponsors. So that's really great.
Thank you, Philip. Sinet, my next question is going to be to you. Deal sourcing is one thing, and Philip, thanks for sharing that. You have your sphere of network, you sourcing with your relationship, and now we are network is multiplied by, you know, how many community members we have now. So deal sourcing has become easier. But Sinead, what were the challenges that you were facing? Like, you know, how did you qualify what you're gonna raise capital on? And especially as a capital raiser, as a fund manager, right? You get at the back end, you get a lot of chunk at the back end, but you know, the cash flow becomes a problem in the front end. How did you manage that kind of the deal economics, negotiating that deal economics with sponsors? And how did that work out before Connected Capital with you?
Yeah, that's one of the biggest challenges when negotiating a deal that, you know, Philippe talked about figuring out if it's a good deal. Once you know that it's a good deal and you want to go raise on it, you have to go and ask for what you want. You know, you go into it with an offer of how much you're going to be able to raise and what you're going to be able to give to them, but you have to be willing to ask for what it is that you want. And I've just by trying to give as much value as I possibly could to the team to try to get as much as I can back. And when we're talking about a fund of funds, one of the biggest things that we give as a value is the amount of money that we can raise. And so it's a careful balance of committing to a certain amount to raise and making sure that you can follow through with that at the same time, right? So the more you commit to, the better terms you're going to get, the more money you're going to make. But if you fall short of that, then there's some consequences on the back end. And let me prove that out to you with a little story real quick. I raised capital for one of the biggest names in the industry through the fund-to-fund model. And I committed to raising $1 million with them. And went through the entire fundraise process and everything like that. And I came up short. I came up with about $900,000. So I was $100,000 short. And I had to go with my head hung low and say, I'm sorry, I'm not going to make it. But can you still give me the same economics? Because there's a lot of expenses and everything to set up a fund. And if I didn't make the $1 million, I would have actually lost money by raising for that deal. And so basically it's about the relationship and asking and, you know, being careful not to overcommit.
Well, thanks for sharing that story because it's so important because you have committed a certain returns to your investors, certain splits to your investor. And fund of fund model, that's what's the definition of it. They have signed it. So you're obligated to give that. And it's just so sad with just 100K less, 90% done. You know, you still had that issue going on. I'm glad that in Connected Capital, we're kind of managing that. And it's stressful, right? Not to mention, it's not just financial obligation, it's stressful. Bobby, go ahead.
Yeah. So this is for Manish. Manish, what were your main challenges or pain points you faced when you were trying to identify, you know, good deals, right? Because every deal, you know, that comes into your inbox or somebody introduces to you is a good deal, you know. But how do you sift through dozens and dozens of deals to say, you know, which ones are worth exploring?
I get deals every day. I'm in South Florida. I'm in Fort Lauderdale. There's a big, you know, this is a big place for real estate deals. One of the biggest problems that is there in these deals is they don't allow you to do any due diligence. They could be your best friends. They could be people that you know very well. You start asking invasive questions. They don't return your calls. They don't respond to your request for documentation. You don't know what you're getting in. You don't know if you're getting into 10 feet of water or 2,000 meters of water. And we've all seen the consequences fairly recently where certain foreclosures are happening and LP investors are shocked, really shocked. Their deals have gone bad. But I think you see it's a lot of give and take. You need to build trust with people and you cannot do it yourself. If you go to anyone and say, I will raise X amount of money for you, they're first of all going to take advantage of you. Everybody has a vested interest. Brokers are there to make commissions. Lawyers are there to make their hourly money. Nobody wants to talk to you because of the benevolence of their heart. You know, they're out there trying to make money out of you. What you want to do is find people that are willing to fight the fight with you as long as you do your share. you're not going to get people that are going to give you freebies. And the only, I mean, I'm not shilling for Connected Capital, but this is one of the only platforms I've found where when you go and talk to the sponsors take you seriously. And we're talking big guys, right? $2 billion portfolio. Otherwise, it's very difficult to even talk to a person who's got a $10 million deal and convince him that you are the right partner for him, that he can start sharing with you his proprietary information. And a lot of that trust building, a lot of that having the ability to confidently raise money and go tell your investors, hey man, this is the best deal for you, requires the ability to ask any sort of a question from the person who's bringing the deal to you, and also giving them that comfort level that they are talking to a group of people that will keep their commitments. That requires people alongside on your team that they can see, that they can confidently feel confident that this team looks like it's going to raise that kind of money that they're talking about. So it's a lot of give and take. It's a little bit more human oriented than financial, but I think it's a developing situation every day.
Love that, Manish. I think, that's really important. The power of the group and this community, each one of you actually enable us to have that power of community, go and ask the difficult questions, and they're not refusing to answer those questions because you're not a singular entity. Now you're like at least, 10, 20, 30 fund managers asking those questions. So, we are very grateful that, people like you enable us to have that power and can ask that questions and difficult questions, right? So we talked about a little bit about life before Connected Capital. This is focused on due diligence, and why Connected Capital is focusing on due diligence. We need to know the backstory of it, right? So Bobby, actually, my next question is going to be to you, actually to us, that, what motivated us to start Connected Capital with such strong focus on due diligence. That's kind of the core, the heart of everything, the due diligence, the due diligence, due diligence. What motivated that?
Yeah,
That
no.
start?
Very, very good question, a very important question. So when you are an LP, you get the offering memorandum, you see deals, and you get the sponsor who's they have to be optimistic about those deals. They have to project positivity and profitability and all those things. It's their job to project positiveness about their deal. It's only when you peel the onion and go under the hood, you realize that it's got some wrinkles, it's got some issues, it's got some challenges. And for me, it was having I invested with a very well-known syndicator out in the Bay Area, very well-known, raises a lot of money. But he's a machine, and my deal did not go well. So I actually had a huge loss in that deal. So I went back and I thought about, like, what happened? What did I miss? And what I missed was a proper high quality due diligence and underwriting. I basically took their word for it, right? At that point, this is, 7 years ago. The deal eventually died, 4 years ago. But the whole incident, kind of shook me, and it made me not want to invest. And then it wasn't until you and I connected and we said, how can we build a better mousetrap for doing deeper due diligence, deeper underwriting, deeper access to the real sponsors who are experienced, they've been through the different cycles, the best in class sponsors that we're always seeking. So that's what was motivated me to start this group.
Thank
So
you, Bobby. And I think, and I think I'm just gonna add a little bit color to it before we go to the next question. For me also, right? I mean, my focus was on due diligence, and it was getting exhausting for me to do this alone. And sometimes I wouldn't be able to even do the due diligence. So my thing was that, if I'm having that pain point, somebody else is having that pain point somewhere else. So how about collectively come together and try to avoid this? And if together, if we can, avoid stepping on one landmine, can we avoid all landmines? Probably not. There's still risk associated. But how about even we avoid to step on one single landmine? I think this is totally worth it. So that's that was a pain point for me.
Yeah. So I think all of us have had similar, hopefully not as bad as my situation, but we've all had our little accidents with sponsors, and we look back and say, what if we had done our homework anyway. So I think the next question, Madhvi, is for you. At Connected Capital, what are the key areas of focus when raising capital? Can you walk us through what a structured due diligence process looks like?
Absolutely, Bobby. And before that, I'm going to ask a quick insight into, the fund of fund model, right? We raised in the fund of fund model. And Bobby, I'm seeing this fund of fund model on the rise. There's so many people attracted to the fund of fund model, and it's literally like a wave of people going towards it. What's becoming very scary is that how many of these people are raising capital in fund of fund, think that this is easy, are actually doing that thorough due diligence, because that's the responsibility to our investors. So it's becoming more and more scary, right? So really at Connected Capital, the areas that we focus is pretty much what Philip and what Sinet and what Manish is looking at, right? Everything, right? From the investment, if this is the right fit for investment, the business plan, but mainly the underwriting, right? The underwriting, looking at the background of the sponsor, looking at doing this background checks. There, pretty much in Connected Capital, the way we are structured is that we have like a checklist, which started like a 200-point checklist. Now it's at 230 point, and it's just keep on getting added to it every now and then after each due diligence. But that checklist is kind of configured into different areas. The sponsor due diligence probably has 30 points in there, right? Running the background check, whether they have, some different aspects of it. And we'll talk about it in a little bit. But underwriting, the legal, the debt structure, the physical due diligence, including, lease audits and stuff like that. So we have that kind of definition of in the structured due diligence, so that we can try to do this together. And each capital raise, each due diligence, we actually look at it, we look at it together. So I think that's what, the Connected Capital due diligence looks at it. I'm going to ask my next question to Sinet. What is, Sinet, your specific area of expertise within due diligence, or your favorite pick of the poison? And how do you develop your skills in this area and become such a recognized expert in this area?
Thanks, Manvi. Being a real estate coach, kind of like as Philippe mentioned earlier, I've got to be able to know and work on every area of due diligence. So I can do just about anything, but I naturally gravitate to the legal review and the legal documents. And the reason for that is because I just have a natural affinity to read everything. I'm the guy, when I bought my very first house, I walked into the title company and you get this stack of papers, like this big, and most people just sign it. I literally stopped and read every single line. And I just have built this grasp of understanding of the way legal contracts work and what the different terms mean. And it's just really easy for me because I've done it so many times. Now, I won't say, I'm no attorney or anything like that. I'm a lay person. My attorney says to me on multiple occasions that I'm a lay person, even though I'm a sophisticated lay person. I'm still a lay person, but I understand all of these things because I've done it so many times and I've done all of the research. So legal documents, PPMs, contracts, things of that nature. That's really where I shine.
I love it, Sinet. Somebody can be overwhelmed with this hundreds of pages of documents.
Yes.
Bobby, you want to go ahead with the next question?
Yes. Let me see. So for Manish and Philippe, can you share your your areas of expertise and kind of share how you honed your skill. I know in due diligence, we in our group we dive very deep, but everybody has their area that they feel really good about, whether it's looking at the loan, the capital stack, the underwriting, the Excels, and the assumptions that they're making, and the demographics. So Manish, how did you hone your skills in underwriting? Because you're our designated underwriter.
I was lucky. I was a founder for 20 years, and that's, every day we would be trying to pay the bills, and we would be looking at P&L, and we'd be trying to figure out where the numbers were going and why the money was disappearing. But I think that in real estate, underwriting serves a very specific purpose. You are trying to quantify risk, and it's very important to take things and break them apart. And underwriting is the only way that you can take a real estate project apart and try to look at the nuts and bolts. And again, there are certain situations which are completely projected. There's no guarantee that they're going to happen. Something like development is a part of it. You are completely projecting everything that's going to happen in a development project. But the moment you go into cash flowing assets, you have much more certainty of what the rents are, what the expenses are, what the comparable sales are happening. And underwriting serves to minimize that risk of investing in those kinds of assets where it's all about finding out where do you see the cash flows going on a discounted basis, you know, compared to, let's say, whatever interest rates are running today. That's just the way modern portfolio theory and finance theory works. You got to find ways to discount all of the future cash flows to today's net present value and see if that's something that works for the kind of risk that you're taking. And that's the kind of modeling that financial institutions do. So, I hone my risk in financial hone my skills in financial analysis simply because that's where I was coming from. But again, at the same time, the only thing I can tell people that want to do real estate is you got to know how to do underwriting. This is a very, very important skill set. And if you don't know it, learn it. But this is a core aspect of being a successful investor in real estate. And there were certain parts of underwriting which I didn't know, and even today I keep learning. And I think it's very important for anybody active in real estate investments to continue to hold their skills in underwriting.
And I'm going to add real quickly to it that, when I started, doing the underwriting, and I, kind of created my expertise on that, I thought I'm an expert in underwriting. And in connected capital, when I hear sometimes from Manish, sometimes from Sinet and Philip and Jeff, and suddenly it's like a new aspect of underwriting that I have not, realized before. And this can only come from the experience. This is not coming from the coaching. This is not coming from looking at those videos. This can only come from, getting burned by these aspects and refining your criteria, right? So again, I'm very grateful to be able to part of this community and learning, as Manish saying, every single day. Philip, go ahead and talk about your expertise, please.
Yeah, I'll second Manish on the underwriting. That's something, with my background in engineering, I've always been very comfortable using Excel spreadsheets, or spreadsheets in general, and building complex models. And just making sure, understanding how the projections, all these numbers, they flow together, they make sense. Was there any assumption that was maybe out of the norm? And that's why, like, part of the steps is, we're redoing the underwriting and tweaking the numbers a little bit, making sure that everything stays put together, so and the returns make sense. So from that standpoint, I think it's definitely a very, very important process that we're going through the underwriting. And the other thing that I like to look at as well is all the financing aspects. Just making sure, it's like what's the loan to value, and that type of number is their preferred equity, and that type of thing. So just to make sure that the deal is balanced from that standpoint.
Makes sense.
Yeah, go ahead, Bobby.
I think so I think we'll jump to I'll talk a little bit about how we leverage third-party tools. Not only are we using the collective knowledge of our fund managers when we're doing the due diligence and the underwriting, their experience, all the vast deal flows that they've looked at, but we also bring in neutral, non-emotional, non-connected entities that are, that are not partial to one sponsor or another. We bring in a third party who is just there to provide us data and full transparency and accuracy on the numbers. They have access to all of the data about submarkets and markets and demographics. So we actually leverage a lot of things that most LPs won't be able to. The amount of work that goes into the underwriting and the due diligence, it's hours and hours of data crunching and research and checking the numbers from different sources. Some of them are paid sources. So most LPs kind of gleam over that. But in our case, at Connected Capital, we actually use that very extensively to do the underwriting. So I just wanted to kind of touch on that.
If I can jump into it, because that's something, Bobby, I'm always, I'm the one that's heading the underwriting in Connected Capital. And I got to tell you, Bobby, it takes hours and hours and hours of sitting through small itsy bitsy numbers to get to the returns. And I know there's a lot of new folks that are not a part of Connected Capital. In Connected Capital, we almost analyze at an average of, I'd say, Bobby and Madhvi would know better, 5 deals before we choose a sponsor. And there are several deals, like I think we spent thousands of dollars just on underwriting resources, and spend a bunch of deals. I think I personally spent 50 hours just sitting with the underwriting team, going through the numbers, and then at some point it was decided collectively by the fund managers that that was not a deal that was attractive enough for them to move forward on. But where did that knowledge and decision making come from? A substantial amount of it was provided by how we did the underwriting. So I think that underwriting is one of those things. It's like the Karate Kid, all that, the thing Mia, I'm forgetting the karate sensei's name, but he says just keep doing it. Just you can't count the hours. You have to grind it out, but you have to also love it. You can't just say, "Can I just finish it off in 2 hours?" And more importantly, I think you will hear that from Madhvi if you join Connected Capital. The best deals that you do are the ones that you don't do, right?
You took it away from me now.
Yeah. So I think the real philosophy of underwriting is find a reason to not do a deal, right? And underwriting allows you to see that.
Absolutely. And Bobby, as you said, those third party that resources that we use, they take down those numbers and re-underwrite it. They don't trust the underwriting presented to us by sponsors, and every deal that we re-underwrite if we are going in, right? And even running the background checks, those are the third party tools that we are using, because we run, no matter if you have 10 million in assets under management or $1 billion assets under management, we run those background checks. So that's really important.
Trust but verify, right?
Trust but verify. I love that. You're gonna have some quotes out of this.
Yeah. Well, so actually, I have a name for Madhvi. I call her the Tiger Mom of underwriting.
Oh my goodness.
That's her name. All right. So Madhvi, I have a question for you. Some sponsor team manage portfolios worth billions and have stellar reputations. At least online, they have great reputations. in these cases, is the sponsor due diligence still essential? And can their reputations be trusted? So there's all these celebrity sponsors, right? In our world. And should we just take their reputation and what they are saying for granted, or should we take pause? So yeah, share your thoughts on that.
Absolutely, absolutely. And Bobby, underwriting is kind of the backbone of a deal, but the sponsor team, I would say that, the brain and the heart of a deal, because a good deal, I mean, if you have a really good sponsor team, they can take a good deal and they can make it better. But if you have a bad team, they're going to take a good deal and they take it down to the trenches, right? So that's really important, whether they have the reputation. And a lot of people, and I mean, I see this kind of a trend, if you don't do that deeper due diligence or you can't ask that hard questions, they actually just look at sponsors, high level, and look at that, hey, they have been doing it, they know what they're doing, they have $1 billion portfolio, why ask more questions? But no, you need to ask questions. You need to kind of, peel it like an onion and ask few more questions. So in fact, our due diligence checklist, that 230-point checklist, we have sponsor items, about 25, 30 items for the sponsor checklist. And one of the most important, and I would say that's the red flag that I look for, is the background check, right? In the any past history, I mean, we have seen so many people, syndicators, good syndicators with reputations, 10 years of, history, providing that consistent returns to investors, just going through this fraud processes. Looking at their background check can tell you a lot. That's a red flag. If they say that, no, I have $1 billion portfolio, you cannot run a background check for me, that's a red flag that itself. So, that's one of the things that I focus on, that we have to have a background check executed, right? So no matter what their portfolio is, no matter how their experience is, you need to run few other checks, right? So for example, whether they have the E&O insurance, right? What if there is, how many people in their team? Do they have a backup for each other? What if there's one person team and something happens to him, right? Do they have like a key person in insurance? So we ask these kind of difficult questions. We also check references, right? And so for references, we have like probably 5, 10 interview checklist questions, like calling their current investors that, hey, are you participating in their deals? Are you not participating? So we want to talk to those who are not participating in their current deals. And would you repeatedly invest in this investment, right? Would you bring your family to this sponsor in investment, right? So there are many things, right? So, this is second red flag, I would say that, which is not a red flag, which is kind of a good thing, that if they have vertical integration, right? If they have vertical integration, it's kind of efficiencies, right? This is the efficiencies, the scaling can be happening in that. But then they also create a path that how they're paying internally to each other's, the companies, and how is that cycle is working, right? So it's very important to have that question asked, that what kind of stakes do you have in brokers? Is your wife a broker, or is there some relationships, right? So those are
Conflicts
the
of
things that
interest.
needs a
Yeah.
conflict of interest. That's really, really important. So we have 25, 30 points checklist just for the sponsors to review that. And we have actually created like some process around it. And you know me, I'm like a very process oriented person. We want to simplify this for sponsors. We don't want them to spend too much time, but we do jump on a call with them, do an interview, record that interview, and that interview could be for all the deals that we are doing with them, right? So we just don't have to keep on doing this every single deal. So yeah, that's what my tidbits about sponsor due diligence. I think that's one of the most important. But Manish, I'm gonna have that second question directed to you. And this is the deep due diligence, by the way, we're talking about. These answers are going to be a little bit deeper, and I want you to guys answer, keeping that in mind. What do you want people listening, people on this call, be at least go back out there, even if they're doing solo or a group or whatever, just ask those questions, right? So Manish, financial analysis, like I said, is a cornerstone of due diligence. Can you explain a little bit about it? And you did allude to it, the underwriting, what it is, but how does Connected Capital approach it, and how do we stress test these deals? I mean, how do we like poke holes with underwriting, and what are the 3 most common financial red flags that somebody should go back and ask that they should look out for?
Yes, absolutely. So I'm going to give multifamily as an example, although this could apply to any asset classes and inside and outside of real estate. If you guys know about underwriting, you know that there are a few key levers that can influence the IRR. And a lot of times what we find is when we are talking to sponsors, just the fact that the way they have structured the occupancy and the rent growth, and small things like they factor in forward 12 NOI in the fifth year or in the 10th year when calculating their sales price. There's small bits of things that are hiding inside under the underwriting, which you must know what you're looking for, and at some point, when you find those things, you're really dealing with uh, things that affect the quality of the deal, and I think that it's very hard for an LP investor to get to that level of depth when they are trying to analyze an investment. They need some sort of a platform support, and they need some team members to go alongside them and work with them to figure out those kinds of items. I mean, we are not alone here. I mean, nobody works here in silos. People work together. There's only Senate and Philippe here, but there are other great, brilliant minds in Connected Capital, Jeff Greenberg, Kent, Lily, all those guys. I mean, we bounce ideas off of each other, and everybody has all kinds of inherent biases and blind spots that are useful to discover when you have really smart people to talk to. So underwriting is as much about having a community discussion about the asset that you're talking about, but also you want to talk to really smart people. And not only smart people, you want to talk to people that are not afraid to be blunt with you, and that kind of a team, finding that kind of a team, I think is very important from you can be LP investors, you can be GP, you can be sponsor. I mean, we have sponsors that are also raising capital. So it helps everyone to be in a group of people that are blunt, sincere, honest, but at the same time are willing to ask the toughest questions. So it could be as Philippe said about capital structuring, as Senate said, it could be about the legal documents, and there are certain there's so many resources inside where you can bring in lawyers, you can bring in people who are expert in preferred equity and all kinds of other capital stack components that you can discuss those issues with if you encounter them in a particular deal. So there every deal is complicated. There could be a mezz component in there. There could be co-GP components in there, and you wanna be able to reach out to people who've had any sort of an experience with those kinds of situations. But I think I mean, we in Connected Capital have a lot of those kinds of resources. So that's a great asset.
Excellent. Philippe, this question is for you. Debt structuring and the overall, capital stack has been in question. There's been a lot of failures in multifamily deals due to many factors. There's not one or two factors, there's multiple factors. So why is evaluating the capital stack so critical during due diligence as we move forward?
Yeah, I think it's very critical, maybe potentially the most critical part, because if you think about when you buy a deal, any deal, there's going to be a debt component to that purchase. So, and at the end of the day, that lender, they're going to be the number one investor in that particular deal. So if you think about where investors, they're going to be located on the capital stack, they're going to come after the lender. They will be paid after. So the lender, they have a more secured position. they will have a lower interest rate, in general, but there's more profits to be shared by the common equity or the investors, but it's a more risky position. So, if you put that in perspective, and sometimes, just to add complexity, Manish has mentioned preferred equity and mezzanine. So mezzanine debt would be like in between the senior lender. You may have mezzanine debt and you may have preferred equity, and then you have the investor, the common equity at the very end of the stack, which is again is the most, becomes the most risky position. So, as fund managers, when we look at a deal, we ask ourselves, say, what can go wrong, right? So what's the loan to value, especially if we incorporate the lender, the mezzanine, if there is any preferred equity, if there is any, we don't want that to be that ratio to be too high. We don't want to be at 90%, right? Because even though, if the deal goes perfectly and you're 90% loan to value leveraged, you're going to make a lot of money. But the question is, if the deal doesn't go well, what does that mean? And, it's like a double-edged sword, and things can go very wrong very quickly. So that's why, for instance, what we're looking for is reasonable loan to value rates, such as, in the, maybe 60 to 75%, and that would be including preferred equity if there is any.
Yeah.
So that's one thing that we're looking for when we analyze deals. Other things we look at is obviously the interest rate. Is it variable? Is it fixed? Is there a cap, a rate cap, or not? And those are other things that we're looking for. We're also taking a look at the loan guarantors. Who is signing on the loan, who is responsible for the loan, even if the loans are non-recourse for larger assets, there's still somebody signing off on the deal, and they are supposed to maintain a net worth that would allow them to really support the loan, and that's very important for the lenders, which, by the way, themselves, they're going to do some due diligence on these on the people who are going to sign the loan. So we can talk for a long time about this, but in
No,
the
I
interest
think
of
I think
time.
Philip, yeah, no, I think Philip, that's very crucial what you said here. And I hope you guys, I mean, you're taking at least some notes of it, because literally, what these guys are sharing, even if you take one bit of it, like what Philip shared about LTV and how crucial that's a landmine right there. You look at the LTV, that what's the, LTV for the loan that's coming in, but when you add the pref equity on top of it, and then you calculate the LTV. We have refused deals because it was coming close to that 80% or 90% even sometimes, right? So that's a landmine right there. You go back and you apply that and on the deals that you're doing. So hopefully you're taking notes. Sinet, I'm going to turn it to you. I talked about, reviewing these hundreds and hundreds of pages of legal documents that could be overwhelming, the PPM, and you're like, you make it look like piece of cake, which is not, but we have built such a strong due diligence checklist for PPM too, right? To kind of streamline that process. Tell us like at least three red flags that you look for when it comes to PPM. And it could be exhaustive. I don't think three is justification enough, but one of those three things that you could share that we look for.
Yeah, there is a lot to look at in a PPM, as you mentioned. It can be overwhelming. I've seen them be, the legal documents be 200 pages, 300 pages, as you alluded to. And we could do an entire hour-long webinar on how to read a PPM and what to look for, and probably nobody would join it because it gets kind of boring and tedious, and the eyes start to glaze over. But I would challenge anyone that's on here, especially if you are going to be a fund-to-fund manager, to take some time and read one, right? Even if you're not the person that's responsible for doing all the due diligence, take some time and read all the way through one and jot down some things that don't make sense to you. And then do some Googling or ask ChatGPT what it means. and just try to learn that. So that's the first just challenge I'd like to put out there to everybody. But there are a couple of key aspects that I would really like you to really pay attention to. And the first one is the concept of return of capital or the return on capital, right? And there's
Landmine right there.
yeah, it's absolutely huge, right? And it can make a really big difference to your returns of how the money that's coming back to you is being treated. And the short version, just real clear, is if it's a return of capital, every penny you get back lowers your basis in the deal. And the returns mathematically are still accurate probably in the underwriting, but the actual total money you're going to make is a lot lower. The second one that I would really look for is who has decision-making power. We've talked a lot about the team of people that are on the deal. Philippe just talked about the different lenders and things like that. These lenders have a lot of power and a lot of authority. A pref equity person, for example, that you guys were just talking about, sometimes their contracts say, if they don't like the color you painted the building, they can come take it over like that. That's extreme. It's not going to be just because of that. But the point is they can take over the deal anytime, and you really got to understand who has the decision-making power. And just a little sub caveat of that is how and can the investors take control of a deal, right? So specifically, how do you remove a manager, right? How do you remove the managers from the deal? I've heard countless times stories about deals that are going wrong and deals that weren't done properly. And at any given time, if a sophisticated investor knew what they were doing, there's a process in the PPM and in the operating agreement that specifically spells out how the investors can pool the other investors' votes and take over a deal. So those are the three key things I would look for.
Love that, love that. Like I said, right, every aspect that you're just mentioning, this is just 3 of probably 25 for that legal perspective, but that's a landmine right there. And this is what we are doing on every single deal. I mean, look, imagine how exhaustive it could be if one person starts doing all these aspects, right? So I'm going to quickly kind of, provide you that behind the scene look, behind the curtain look, right? We want to do the due diligence, but we also don't want to go into that analysis paralysis phase, right? Because we want to kind of do this in a quickly, timely manner, respond to our sponsors, and get on that deal and talk about, further the deal economics, negotiating that, which me and Bobby do a lot when it comes to the deals, right? So we focus on that. Of course, to be honest, we started with this long process of due diligence, right? But now we have kind of tightened our processes. We move through it swiftly. Especially for repeat sponsors. Now the delta is small, right? Now we know how they underwrite. We have done their sponsor due diligence, their 25, 30-point checklist on the sponsor team itself. We understand their underwriting. We understand their market criteria. Sometimes it's just a neighborhood in the building, right? So those are the things that we actually have achieved efficiency in doing this due diligence quickly. Out of almost 10 deals that get presented to due diligence. By the way, if you want to try out the deal presentation and how it looks like, we meet every Friday, rain or shine, even during long weekends. We meet, tomorrow is Friday, so join us for another deal presentation. They present the deal, we ask Q&A, we do a closed door conversation, and then we do the due diligence, right? So 9 out of 10 deals are getting rejected. Only one deal is what, sometimes we are just patient. We're just like since June for 3 months, we didn't raise because nothing came through to our scrutiny. So we are saying no to those deals. So that's really important. And then running that timeliness of that process is also, completed in kind of an efficient manner, right? Because now we know how to work together as well. So I'm going to jump to the next session where we're going to actually talk about the actual case studies, right? So Manish, my question is to you is that, can you share a specific example, big sponsors probably, without taking names, of course, that, they presented this deal to Connected Capital And we were like, man, we're gonna say no to them. How are we gonna say no to them? But we did go back and said no to them. Uh, can you share one of these examples, please?
Yes, absolutely. I think we have too many of them. Boy, I can go on and on. There's so many deals that we did a extensive due diligence. These groups, they are pretty large and famous and have a lot of influence in the real estate industry, and they fully expected us to agree with every one of their assumptions. And we, ultimately we decided that that was really not up to the standards that our fund managers were used to. And I think ballpark is a lot of it. The kind of rejections we've had, and I don't like to call them rejections. I think it was a mismatch of risk profiling of our fund managers versus the property itself. So I'm pretty sure the property ended up very successful and did raise the equity, but one side we had the capital structure, and the other side it was more about the submarket and the rent projections. And I'm referring to multifamily again. I mean, there's other asset classes, but they are very similar in analysis in real estate. So, in capital structure, you want to be risk averse as much as possible. And anytime you have preferred equity coming in or any of those things happening, which allows external, people outside of the lender coming in and taking a better position than the LPs, then you do get worried, right? I mean, right now most of the investments are not happening on a JV basis or on a co-GP basis. They're happening on a fund of funds basis. The fund of funds mostly go in as LP investors. So you're literally sitting at the bottom of the capital stack. Now, since the senior lender is right there at the top, I mean, they're the quasi owner of the property until they get their money back. Anybody behind them is becoming, is literally as influential as the person that you're investing money with. And a bunch of times when we were analyzing deals, we were kind of uncomfortable with the way the capital stack was structured. And as Philippe mentioned, sometimes it can be the LTV. I mean, we saw LTVs that were approaching 85%. And it wasn't something that we were really comfortable with. We wanted some comfortable amount of equity in the deal. And I mean, it's not like there's a hard and fast rule, right? It's not like you can only invest in 60% LTV and not with 85% LTV. It's all about the quality of the dollar that is being earned, and there's so many factors that you want to analyze. As Senate pointed out, you have to read the PPM and this contracts. There, even a simple $40 million deal will have like 20 contracts, and you literally have no choice. You have to read through them. So I mean, the quality of the capital stack is what dictates if that's something that is attractive. And it's a conversation. There's no black and white. There's no way that you can say I'm going to go to the east and I'm not going to fly to the west. No, I mean, you talk, and sometimes you wake up in the morning and you feel great about the deal and you want to go ahead and start raising capital for it. But the other part is about the quality of the dollar being earned. We get into the nitty-gritties. We want to know what the sub-market trends are as far as the rents are concerned, occupancies are concerned, evictions are concerned, and frankly, underwriting is purely projections, right? It doesn't really exist today. It's going to actuate itself in the future. So your guess is just as good as the sponsor's guess. And a lot of time our fund managers just didn't buy the projections that the sponsor was giving us, whether it was the pro forma rents or the occupancy trends or vacancy issues or rehab rent bumps or most importantly, you got to remember, if there's nothing else you take away from this about underwriting, remember that exit cap rate influences a significant part of the valuation. And a lot of times we get stuck on the exit cap rate because if you move it even by 10 basis points, sometimes the IRR moves about 1%. So and again, I mean, it's a conversation. Sometimes people are comfortable investing in a deal which is giving you 12% IRR, and because you can see a more solid dollar being earned. And sometimes the fund managers said, you know what, we're not gonna invest in this deal, even though we see 25% IRR, because we just don't we have comfort with the quality of dollars that this proposed investment will bring in. So I could give a lot of different examples, but I mashed it up, So if you want me to be more specific, I can also do that.
Thank you, Manish. Thank you so much. We really appreciate it. Bobby?
Yeah. So I think the next question, if I picked it up correctly, is for Senate. Senate, have you worked on deals involving non-multifamily asset classes such as self-storage or mobile home parks or some other asset classes? I know you're working on one with us, which is not multifamily, and we're pretty excited about that one. So if you don't mind sharing how the community has helped, there may be gaps, like somebody may be a specialist on multifamily or a specialist on self-storage or mobile home parks or land flipping, but the community, wherever there's gaps, we may have other people in the community that can kind of help out. So and I know you have business experience, so what made you comfortable with kind of evaluating non typical asset classes?
Yeah, but that's one of the best parts of the community, Bobby, is there's so many different people in there with specializations in different things, right? So I have worked on a mobile home park deal, and there's a couple of people in our group that have done several mobile home parks in the past, and so they know what to look for, and they know what you can underwrite towards, and what kind of projections you can turn around. Same thing with self-storage, right? We've got a couple of really good operators that are self-storage experts. And so if somebody brings us a self-storage deal, those experts can come on and help us understand the different metrics that we should be looking at. Self-storage the process is just different than it is for multifamily, and the metrics that you look at, versus net rentable square feet, right? Versus price per unit, that type of thing. And it's because we have those experts in the community that understand it. I've got really good expertise in multifamily. Also, as you mentioned, I've worked on several business deals in the past, so I'm very comfortable looking at private equity and things of that nature. But I'm not necessarily an expert on self-storage. So I have no problem picking up the phone and making a phone call to another one of our members to help fill those gaps.
Yeah, and I must say, bringing back this answer to home, Sinet, you bring tremendous expertise, and you just politely mentioned about the businesses, and Manisha's experience in businesses too. On one of our recent deals, that is the expertise actually community leveraged from your expertise and learned so much. That was a learning experience for me as well. I don't know if I'm ready for the businesses yet, but that's the beauty of it. If I'm not ready for it, I stayed back and the community went ahead, right? So that's, it's a community collaborative environment, but still one person can stay back. I think that's the beauty of it. And one of the example I want to mention personally is that I remember, Manish, and this was, back then when this pref equity component came in picture, and there was like 10 clauses that the pref equity can take over the deal. And something like, if the cash flow is not provided within 4 days or is delayed by 4 days, they're going to take it over, right? So we were so scared into going into this deal, and this was a good deal. So we tapped on our existing resource who has done this pref equity terms on being on a receiving side, as he has gone into this several times, and we sat down with him for a couple of hours, and our community greatly helped with that. So that kind of, we kind of hit that roadblock. So I love this kind of many examples, many case studies that we have had together. But we kind of are coming towards the end of this session, and we want to wrap it up. But just to wrap it up, we want to, talk about, this is a question to all of you, all three of you, that, based on your experience, how do you think that connected capital has helped you, not just for the due diligence, of course, for the due diligence portion of it, though you bring in that expertise, that collaboration, how does that help you And also beyond the due diligence, how has it shaped you as a fund manager? Because being a fund manager, as we all know, is not easy, right? So just whether you're talking about that managing that stress of raising capital or optimizing that deal economics to get some cash flow up front or any other aspect of fund management. So Philip, I'll start with you on that question.
Yeah, that's a great question, Madhvit. I think what my personal takeaway, and as soon as I joined the group, I was really impressed by the quality of the attendees, and by the mean of what questions were asked when we are presented the deal. It's really a lot of sharp people who are joining every Friday, and when we are we have we let the sponsor present their deal, and after we have a Q&A session, and it's we can ask all the questions we want, and they are really very pertinent questions that are asked. And after that, we do a little bit of a debrief amongst ourselves, and then now we hear like further insight and where people stand, and how they perceive and understand what has been presented, and what are the questions that they have about the deal at that point, and critiques or praise that can be shared with everybody else. So that's really a good experience. But as you kind of mentioned, of course, by all working together, we certainly reduce the workload quite a bit. And moreover, in case we cannot meet the requirement, like the Senate explained earlier, like his story, like he didn't meet his $1 million mark. I think as we work collectively, we can leverage each other's resources and network. In case one of us is falling short, maybe somebody else can pick up what's needed to meet the collective goal. So that's very powerful to meet the sponsors' requirements from that standpoint.
Very good. Very good.
Thank you,
Very
Philip. Thank you. Senate, how about you?
So many hands make light work. That's the biggest thing. This group, all of the people coming together to do all of this due diligence and the capital raise together. It's just so much easier and so much more fun when you have like-minded people that you can work with. That's really what it comes down to. That's the biggest benefit, I would say. But then also your second part of the question, how has it changed my perspective as a fund manager? It's really allowed me to increase the quality of the investments that I'm looking at and working on. And to be able to access things that take such a larger check size to be able to get into. Anybody can start as a fund manager, but you can't always get the same institutional level investments that you can get through a group like Connected Capital.
Yep. Very good. I echo that. I mean, when you're going in as a collective group with a bigger check size, sponsors want to pay attention to you, and everybody wins when we do that. So great.
How about Manish? Manish, do you want to elaborate how it's Connected Capital has helped you, in your fund manager journey as well?
Yeah, I mean, personally, I kind of put a lot of emphasis on honesty, right? When I'm interacting with people, I want to hear just plain, simple truth. And for some reason, and it's my personal experience, I go out in the real estate industry and everybody is bullshitting everyone else. It's exhausting, right? I think I must have, just because I was bored, I must have logged into a few webinars this week, and there are people going on, and they're like, "Oh, real estate is going to make you billions," and I gave up, my job, and there's so much, crap out there. It's exhausting. You're just getting, it's a tsunami, and the only thing you want is for people to be honest with you. You don't want a lottery. You don't want to be a billionaire. You just want to have an honest discussion. And it's so very difficult because wherever you go, whichever, my personal experience is I go to meetups, I go to groups, I go to conferences, and I mean, Bobby was just at one of the best conferences you can ever go to every year in real estate. And we were having that discussion. It's very difficult to find a core group of people that you can meet with and have a conversation with and hear, you know, just simple words that they really believe in. So that's the first part. The second part is it doesn't matter about connected capital. Find a group of people that are talented, that are inquisitive, that are honest, and that show up every day. And we're lucky to have those kinds of people in connected capital. Beyond that, I mean, it's all in your hands to mold your destiny and find a way to make money. But then there are other people who are like, only $1 million is enough. I want to be a digital nomad. So it's not about having private jets and Palm Beach mansions. It's about having an opportunity to work with good people who understand that uh, only with sincerity and honesty can people come together and make value happen. And in connected capital, I mean, as much as it's about capital raising, it's about creating value. And value is not only created by raising capital. Sometimes you make value but not investing, right? Sometimes you make value by doing the due diligence and learning stuff. And every day you find ways to move forward an inch or a meter. But the way to move forward is to find a good core group of people that you can hang out with every day and and
Love it.
and exchange sincere information. So
Love it.
that's how I look about it.
Love it, Manish. And by the way, we are not paying any of them to say all this, but this is the sincere, and I think this sincere experience, most of you have been with us from the inception, and we truly are grateful to it. I think this has been a great session, and we talked a lot about due diligence, and really we want to know from you, how we can help you. So there is a kind of a poll up there, and we just want to know from you that, how can this community solve your problems, your bottlenecks, right? And while we are filling that questionnaire, Bobby, I have a question for you, and maybe we should talk about where is this vision going, right? Where do we want the due diligence to go? I mean, right now we have the third party underwriting at our retainer. We're running the background checks, and we have this collaborative due diligence, going in. So tell us a little bit about, where this vision is going.
Yeah, our vision is, it's pretty broad, but what we want to do is we've been running this community for about 1 year now, and it's worked out really well. We're getting a lot of respect from sponsors. We're getting a lot of deal flow. What we want to do next is obviously highest priority is to grow our capital, our bank, right? So we're looking at expanding, not only have fund of fund managers, but also have a high net worth individuals that don't have a fund, but they want to invest in. They're willing to write big checks, but they want access to better terms. They want access to the best in class operators. So we're gonna expand, our capital sourcing. The second thing we're gonna do is we're gonna expand the deals that we're looking at. It's right now it's mostly real estate, but now we're branching out into oil and gas. We're gonna branch out into hedge funds, into business roll-ups. We actually just did an investment in a business roll-up. We're gonna go into more into debt, adjacent to real estate, but more into debt. So what's going to happen is you'll be able to join us and see deal flows that, yes, our core will always be real estate. That's our bread and butter. But you're going to see some exotic new investments and new exotic underwriting that's going to happen. And of course, we're going to see more high net worth individuals come in and more fund managers come in. And as there's groups out there that are minting fund managers, we want to make sure that they keep their LPs safe. So if you're a new fund manager, but you don't know everything about underwriting and due diligence and background checks and deal sourcing, come and join us so that you can be safer when it comes to your LPs, right? So feel free to
Very,
reach out to Madhvi or myself, and
yeah, very well said, Bobby. And if you want to, post your link in the chat for, scheduling a call with you.
Yeah.
But, very well said. It's not just about making fund managers. Anybody can literally create a fund of fund. We want to make responsible fund managers. That's important. And, by having this kind of community, which there are other experts, you're gonna leverage that expertise to be a better fund manager, to do a better due diligence. And also this kind of push is needed, right? Sometimes you are part of a mastermind for a year and you haven't raised capital, or you haven't done a deal, or you haven't participated because you just don't know if it is enough, what due diligence that you have done. So coming together, participating in collective due diligence, now you can actually be the part of the flow and actually start doing it and start getting all that money's worth back that you have been spending. That has been, our focus. And we are, streamlining this process is about due diligence. We're constantly looking at new resources that can simplify, can automate some of these things, but at the same time, the human interaction cannot be completely taken away. We're also looking at systemizing the processes that post capital raise, when actually you go into the deal, what kind of reporting, what kind of, monthly KPIs that we can manage from a sponsor. Some sponsors are great at it, some are not. So that's again kind of, something, that vision that we are looking at in the future. So be a part of this. This is growing. It's it's free to join. So there is nothing to lose for you to come in and join and experience this. If you want to be part of the due diligence and capital raise, then there is a small cost to it. And most of it, most of our fund managers say that they have recouped this cost just by that additional negotiated economics upfront, cash flow upfront that's coming in. Within a couple of deals, one deal or two deals, they just recoup this cost. It's like a break even. And we are investors, we look at break even very intentionally. So that's that. And I do have, one question here. If you have more questions, please post into the chat window or Q&A. Warren asked for Sinet, did the sponsor then cut your returns on that deal that you shared, or lower the raise? That's a good question out there. But if you
Yeah.
have more questions, please put it on there. Sinet, go ahead, please.
So they did at first, and I had to go back to them and basically just got down on my knees and begged.
Oh,
And they did give me the full $1 million terms, but that was after going back to them and begging them to do it. And they didn't have to. It was just because they were nice. So they were not contractually obligated to do it.
thank you, Sinet, for sharing that. Wow, that's an experience. By the way, Randy asked that what is the minimum you need for a fund of fund to participate in your deals when you earn that preferred economics, right? So let me share my story. When I started raising capital, that 500K was the minimum to be part of the co-GP. I did co-GP back then, and now I'm just deliberate about fund of fund. I did not, I thought I could easily do it, but I could not, right? I didn't get paid for my first one of the first few deals, right? So for me, it's really close to heart when a new capital raiser come in, and there have been our deals that we collectively go together, but we don't create an SPV. And I cannot begin to tell you how important this is for you as a fund manager, because you're not adding a layer, you're not losing another piece of dollars or the promote in the back end, because we create an SPV. Each one of you, it's gonna go as a separate fund of fund, whether it's SPV, whether it's customizable, you pick. We are agnostic about it. So if I raise, say, $500, if Sinet raises $1 million, or Philip raises whatever, we're gonna get the same exact economics as if we are gotten for that bigger portion, right? And typically our aim is to get the 2 million level economics. One of the deal that we have 90-10 split that is only available for the $2 million raise. But anybody who's raising any amount of money is getting that 90-10 split. So that's really important that you go individually. And I don't want to put a number out there, Randy. I would say reasonable at this time. But yeah, they're first time fund managers. They didn't know what they were doing or what that amount is going to be. And they got that $2 million economics. And that gave me immense pleasure, because as a pain point that I went through, that is the pain point that we could avoid to that beginner fund manager. I slept really well on that day. So hope that answers your question. Any other questions, guys? And I know it's 7:30, and this is this is really late, and we really truly appreciate you guys are hanging out here. But if you have a few more questions for our panelists, and all three of you have been great. Thank you so much for sharing your experience, your journey, and your expertise with us today. If you have time to hang out more and answer some questions, we are here. Feel free to, to just ask more questions. If you want to jump on a call with me or Bobby, we're going to post our links as well here. Yeah, I think Bobby has already posted his link. So if you want to learn more about the community and, just have more questions, just jump on a call with us. And while we have all of you here, can you, each one of you, just, talk about if there are some fund managers here, capital research partner here, working in silos. What do you think if they're on fence? What do you think, they should consider, if they're considering joining Connected Capital, but they're like kind of, hey, I don't want to spend money or I don't want to spend effort. What is one advice that you'll give to them?
The return on investment is worth it.
I would say don't think about the money because it's a small amount. Don't think about the money, but think about the time that you're going to save by doing due diligence, and also how much better economics you're going to get by joining a group like this.
Love that, love that. And I remember Philip and Sinet, you took your own time to actually be a part of this, the community, the paid, it is a paid membership, by the way. It at 4,500 at gold level, where you can just unlimited raises, unlimited due diligence you can participate in. And you can go to connectedcapital.fund and participate in that. And then Philip and Sinet, you took your time. And, when you joined, you actually, did you see that, did you see that return of whatever the effort that you're spending and money you have spent?
Yeah, it's definitely been worth every penny. It's saved me the amount of time it saved me has easily paid for the cost, the investment.
Yeah,
Philip?
absolutely. Same thing. Yeah.
Thank
And
you.
the preferred economics too.
Yeah.
That
Yeah.
paid off
Yeah, I
very
hope both of
quickly.
you are like beyond break even at this point.
Well, the whole idea is that as we join hands, we wanna get, as a fund manager, you have expenses. There's all kinds of expenses that a lot of people don't talk about. The way we've structured our community and our monthly subscription is so that you actually get, and when you join the collective, our group, we're able to negotiate better terms, which flow down back to all of our fund managers. And you'll see that, there's, when you go to a sponsor and you say, listen, on one hand, you got a $25,000 check. On the other hand, you got 2.5 million or $2.9 million check coming in. Who are you going to work with? 200 coffees or lunches, or, flying out to places to meet people versus just coming to Connected Capital every Friday, presenting your deal. A bunch of sophisticated fund managers who are asking the right questions. And that's, that's the way for sponsors to raise money. And because we make it easy for them, they are willing to give us better terms. So you get everything and more back. So yeah, that's how we want to structure.
By the way, big announcement, Bobby. I was just looking at the numbers, and we are almost touching this year, collectively raising $10 million. So we are almost there, not there yet. We will cross that soon. Just few, this active capital raise probably, but 10 million together, and the vision, guys. Our maximum capital raise has been 3 million. We are planning to go next year that 4 to 5 million or even 7 to 8 million by end of the year, so that our economics become better. But at the same time, we don't want to squeeze a lot of juice out of the sponsor team because we want them to be successful. So it's really about growing together collectively, right? And Manish, I know you're waiting to answer that question about just one piece of advice for somebody who's on the fence. So please go ahead and add that, and we will conclude that.
I think I'm just like, look, I'm not a smart guy, and I think that we all have to take the position that we are starting afresh, right? And I'm just like everyone else. I think there's a lot of people that have attended today that have spent 20, 30, $50,000 in all kinds of mentorships. For the price of what you're paying to join Connected Capital, it's a no-brainer. It's an ROI that's going to give you 1,000 times return. And I'm not talking about the economics of a fund manager. I'm talking about what you will learn being in a group of such smart people that are honest and sincere about discussing, sharing their experience and knowledge, right? I mean, with, like, for example, Philippe, right? I mean, I've learned a lot just hanging out with Philippe. He's a very smart. He runs his own mentorship program, and he's a great coach, right? But it just having the opportunity to talk to him and exchange ideas about how to invest in these properties has itself been so enlightening. And I mean, I would say it would be foolish to not take the opportunity to test out Connected Capital as a member and see if it works for you.
Thank you so much, everyone. And with that, I think we are concluding for tonight. Vesi has a question. Which groups do you recommend regarding learning about forming a fund? Seems one has to have a fund set up before joining Connected Capital. Not necessary, Vesi. We are actually, all of us are fund of fund managers. We have done the SPV way, we have done the customizable way. I mean, we have used different platforms. So we actually have helped a number of people to actually start their fund. They were just part of the community doing the due diligence when they were ready. We actually are doing a matchmaking next week, and next Friday is going to be our matchmaking, because sometimes it's so overwhelming to be a fund manager just by yourself. So we are trying to combine some resources together. If two people are interested in creating fund of fund, but they don't want to put that financial resources just out of pocket, one person they can share. So we are actually going to run that so that you can actually be a fund manager. So you don't have to. We actually do have that support, and jump on a call with Bobby or me, and we're going to help you out to be platform agnostic, not necessarily any particular platform. But yeah, it's right here for you to become a fund manager, to continue to be a better fund manager. We always, even during the deal, we talk about the deal disclosures, the legal documents, how to create, what are we splitting with our investors. So there is a lot of discussions in distribution, slicing. We talk a lot about of that, been actual problems of fund manager. So you will see all this here. Thank you, Julian. This is great. Thank you for joining us, Wesley. Thank you so much. Every fund manager or substantial investor needs to be Connected Capital fund manager for deal flow, deep due diligence, for risk-adjusted returns. Very well said. Very well said. Again, thank you so much, all of you,
Thank you all.
from the bottom of the heart, for being here and for sharing. And for you also for hanging out with us for such a long time. We have, a lot of you still hanging out. Any questions, reach out. And I'll see you tomorrow for our
We'll see you
Connected
at
Friday call.
9 a.m. Pacific and
has-
noon Eastern.
It has
All
been
right,
a
guys.
great honor. Thank you very
Thank you,
much.
guys. Thank you, guys.
Thank you.
All
Thank
right.
you, guys.
All
Have a
right.
Good
great
night.
night.